This week on the Property Podcast, we're bold. In fact, it's probably the boldest we've ever been in over 7 years of recording. We're going to talk about two scenarios, a massive boom or a massive bust, and we're going to give you our prediction on which is going to happen.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. This week, as Rob's already said, we're being bold. We're looking at two very extreme versions of the future, laying out the reasons behind it, and saying which we believe is most likely to happen. Now, this is a heavy episode. There's a lot to take in, but stick with it because there's a bit of a twist and you won't want to miss it.
So it's time for our news story of the week, and this news story comes from whathouse.com, and the headline reads, House Hunting Technology on the Rise. Now, the article interviews lots of estate agents and talks about how they are implementing different uses of technology to get through this weird environment we're all operating in right now. So people can start to view homes, and that's really cool, but some people are going to be reluctant to do that. So estate agents are embracing technology. Now, Rob, the interesting thing for me with this story is that while there's a crisis, there's always good in a crisis. There's always things that benefit from a crisis. If you look back to the world wars, technology came on leaps and bounds. That's some positivity. In terms of the coronavirus, it seems estate agents are starting to leave the 1990s, and that's really encouraging to see as well.
Yeah, who would have thought it? All it took was a pandemic. I do think this is really positive. So they've actually been advised to do this. So official policy for what agents should be doing is only allowing a viewing to happen at the moment if somebody has already done a video walkthrough, if at all possible. And then if they like what they see, the viewing goes ahead, and that's to cut down on unnecessary viewings. But I do think to some extent this will stay in place permanently now because it just saves so much time for everyone. And you think of all the time that agents must waste 15 minutes driving somewhere and then waiting around and then driving back for someone who within 10 seconds goes, oh yeah, don't like it. And they could have established that on a viewing. I've looked at some of these walkthroughs, and even without anything high tech, even with just someone in their iPhone going around doing something quite uninspiring, you can still get a really good idea of what it is. And when you combine that with Street View, you don't really need to go there to get most of the data that you need. So even though it's come about for bizarre reasons, I'd like to think that that will become the new normal now, which is good for agents and really good for investors, and particularly good for investors who are remote from where they're investing and who don't have a lot of time.
Quick heads up before we get going. We're giving you so much more at the moment. So on Fridays, you've got the market updates, but we've got YouTube videos still going out as well. And this week, we've released a new video, and it's a bold title. It's our negotiation tips that will save you thousands. But actually, if you implement them, you really could save thousands. So it's a quick video. It's only 5 minutes long, loads and loads of value. So head over to our YouTube channel, Property Hub UK, subscribe, and to make sure you don't miss any of those videos, click the notification bell and you'll be told every time we put one of these videos out. It's exclusive content to YouTube, so make sure you take advantage of it.
We, in common with everyone else in the world, has been talking about coronavirus a lot over the last couple of months. And I know you're probably getting a bit sick of it by now, but as an investor, you don't really have a choice. You need to understand what's happening now beyond just the health aspects and into the government response and the economics of the situation, because that will help you understand what's likely to happen in the future and how you should put your own plan together. We last did a big picture episode on this back in March. It was episode 367, which we called A Rational Approach to the Coronavirus. And in that episode, we laid out 3 broad scenarios that we thought were possible based on what we were seeing on the time back in March. And now, Rob, a couple of months on, I wouldn't say we have any certainty about what the future looks like, but we know a lot more. And I think we've cut those 3 options down to 2.
Yeah, being the geeks that we are, we've done so much reading and watching of videos and trying to absorb the knowledge of the wisest people we can think of and really try to get a grasp of where we're at, but more importantly, where we're going. And this podcast, we wouldn't have been able to put together probably even a fortnight ago, because it takes a while to form a view about the future. And then it takes a lot of bravery to actually broadcast it to tens of thousands of people to say, hey, here's what we think the future holds for us. So we do have 2 scenarios, and we do believe that one of these 2 scenarios could play out. Now, of course, we could be wrong, but we're going to discuss what those 2 scenarios are and then have a chat about why we think they could play out and then end up with which of the 2 we think is most likely.
So we'll come very shortly to what those 2 scenarios are. But before we get to the midterm future and the long-term future, let's talk about this year. because from the conversations we've had already, Rob, I think we're quite aligned on the view that we're not going to see much action this year. We're going to say some things in this episode that are going to paint some fairly extreme versions of the future. But for various reasons, we don't think we're going to start seeing those play out in 2020 itself.
No, it's a very dramatic year in the terms of events, and it will remain so for the rest of the year. We'll have plenty to talk about when it comes to Christmas. But the markets at the end of the year, and this includes the stock market, not just the property market, when you look back at the end of this year, while there may have been a bit of drama throughout, they probably aren't going to be that much different to where they started out. Yes, the stock markets will be lower, and the property market will probably only move a few percentage points either way. It's not going to be big swings. And that's for a few reasons. First of all, it takes a lot for the property market to collapse or surge. And at the moment, there's not enough to justify it going either way. To stop it from collapsing, there's plenty of stimulus. There's lots of money being pumped into the system by the government. It's being propped up. So while things are uncertain, the economy and the property market, because it's a big part of the economy, is almost being protected by the government to stop it collapsing. And if it starts to go down or wobble, then they'll probably introduce more measures to stop it happening. It's not within the government's interests right now for the property market, the property sector, which includes construction and everything else, because if property dips, then all those other areas will be hurt, for it to be damaged right now. They will go all out to stop that. Now, that won't cause a boom this year, but it should mean that it's protected. So actually the property market at the end of the year, although we've had lots to talk about and there's been lots of drama, probably won't be in much of a different position than where it started the year.
No, there's also the fact that it takes so long for data to come through. So for the last couple of months, there have been basically no transactions, and the housing market indexes have actually been suspended because there isn't any data to base them on. Volume is probably going to stay lower for a few months still to come. And when it does happen, it'll include some element of transactions happening at lower prices because vendors who really would have wanted to sell in April are having to sell in June, July, and they're in a real hurry suddenly. So that'll put some downward pressure on prices. But by the time the data from that comes through a couple of months later, it's being balanced out by all manner of other things. So you're getting on for the end of the year before you're really in a position to say what's actually happened. Another reason why I don't believe we're going to really get a clear picture on this year is the furlough scheme. Because in a normal situation, if there's a sudden and immediate drop in demand, then everyone's going to be spending less, companies aren't going to need as many people, lots of people get made redundant all at the same time, and it happens in short order. This time, the government is paying the wages of lots of people who otherwise might have been made redundant. Now, what this is meant to achieve is that this basically stops those people being made redundant, freezes the market until everything's over, the demand comes back, those people go back to work and everything's great. And that's the best case view of how things play out. The worst case view of how things play out is that for some reason that demand doesn't come back and the unemployment that you would have had in May, you have in September, October instead. The reality, of course, is going to fall at some point between those extremes, but it is going to be getting on for the end of the year before, again, we start to get the data that tells us which it is.
I think it's also worth stating right now that while we're saying not much will change, we will go into a recession. We are already in a recession. So we are accepting that. But the recession shouldn't really, this year at least, impact property. So by the end of this year, although a lot would have happened, and we probably feel we've had enough happen this year, a lot would have happened by the end of the year in total, including officially being in recession. But when you look at property prices, they're not that far away from where they started the year. So loads of drama, loads of eventful things happening. But actually with property, it'll be a bit of a nothing year. But that'll be the final nothing year. Because what happens after that, well, Rob, as you've already hinted at, our views are pretty extreme. We haven't got a balanced in the middle scenario here. And people might be surprised by that because that's a safe way to play this. But when we've read and researched and formulated our own views and opinions, there isn't a middle road option here. It's one way or the other.
Yeah, when we did that episode that I referenced back in March, we had 3 different options. And where we've got to now is basically taking out the middle one. So you end up with 2 diametrically opposed alternatives here. The most obvious one is that we have not just a recession, but a severe depression. Millions of people out of work, companies going bust, and so much strain on governments and the financial system that maybe we end up with a complete realignment of the world as we know it. Now, we can talk about that all in a bit more detail. The other scenario, which if you asked most people would certainly come across as the least likely at the moment, Rob, but which we believe is actually more likely than moderation, is a boom.
Yeah, with so much money being injected into our system, like furloughs and grants for self-employed and all the other schemes that are out there, the emergency loans, the bounce back loans, so much money is being pushed into our economy. And we're not alone. This is happening all around the world. So globally, money is being created because they have to get it from somewhere. And this money is entering our economic system. And that money has to go somewhere. It doesn't sit idly. And that money pushes things along, but it doesn't give it a nudge. It's like an express train, and it will surge the market forward. And all that money and all that stimulus will drive us not just into a recovery, but actually the train doesn't stop and drives us all the way into an economic boom and a property market boom, where asset prices surge forward.
So those are our two options, basically boom or bust. And like I suggested earlier, if you went up to people on the street and you stopped them, not that you can do that now, and asked them which of those they thought would happen next, surely north of 90% would say it was going to be the Depression. So I feel like we need to defend the other alternative. So starting from where we are today, how does a boom possibly come next?
It comes back to that point of the money, because we've seen this happen before. What I'm proposing isn't a new radical economic theory. It's just something that's played out time and time again throughout history. It's just that at the moment, while things are dark and gloomy, it's easier to believe that the trend is going to continue rather than a new trend starts. The amount of money that is being created right now is unprecedented. It makes 2008 look like a preschool event. The money going in is unbelievable. Now, the reason why we've wiped out the middle scenario is for this very reason. You either put so much money in that it creates a boom, or you don't put enough in that the economy isn't supported and a bust happens. I believe globally right now, because of the pandemic, that the bust option just can't be considered by world leaders. Now, they wouldn't want it at any time, but if you're going to have a depression, you want to make sure that it doesn't coincide with a pandemic, because you've got a recipe for disaster, and that disaster being social unrest. If you have a depression, you've got a risk of social disorder and extremes coming through. And you can even see that by some of the weird and wacky things that are on the internet around the coronavirus right now. But you marry that up with a depression, then you've got a recipe for global meltdown. Now, I know that's pretty grim, but that's the truth. You've also got Donald Trump right now, who's about to have an election. He is all about the economy. He's the businessman, right? He has to show America that he can lead them through this crisis, but not only lead them through, but show them that their economy is on stable, strong footing. He is completely incentivized to make sure that happens. So printing money? Yeah, no brainer. Let's do it. Stimulus left, right and centre? Yeah, let's do it. When are we paying this back? Who knows? But right now, this is the thing to do, because all this stimulus, all this money will get us out of where we are right now. But what these governments are unable to do is balance it and just put just enough in. And that's almost what happened with the 2008 crisis. They actually probably didn't put quite enough in. And we had austerity, and on reflection, it looks like that was the wrong way to go about things. Not just because of the social harm it caused, but actually from an economic point of view. That's how I judge it. Based economically, it was the wrong thing to do. Forget the social cost. The social cost was horrific. But they should have put a bit more money in there. This time, they're not taking any chances. And all of this stimulus, and this is more than ever before in the history of mankind, will create a boom. In fact, Rob, I may as well let the cat out the bag now. I actually believe this is the scenario most likely to happen because of all the reasons I've mentioned, because of the desire for it to happen, and the tools that they are using have proven in the past that this is the result of these measures. So if you multiply these measures like never before, you end up not going into a recovery. You go into an economic boom. You go into an asset boom, and it surges. It doesn't just go up by a few percentage points. Double-digit property price growth is very much to be expected if this plays out.
Yeah, I completely buy into your central point, which is that you can't get it just right. Either you can't do enough, the patient can't be saved, the depression happens, or you end up way overcorrecting. I don't see how it's possible to get it straight down the middle here. And if you look at the factors that could prolong a recession and turn it into a depression, there's a few different things. And a lot of it comes down to how wealthy people are and how wealthy people perceive themselves to be, which are two different things. So in 2008, everyone was perceiving themselves to be really wealthy because everything was going well. The value of their house was flying up. and you're getting letters through your door every day inviting you to apply for new credit cards. So when that came to a very sudden stop and all that went away, everyone felt a lot poorer, even though they were never really rich in the first place, and everything changed. At the moment, if you're looking at the things that could cause people to feel negative, there's a couple of different things. So there's the stock market. The stock market could collapse. But based on everything the government has done so far, a lot of the tail risk of massive companies going bust has gone away. They've shown that they're willing to put in a lot of support. And if you take out the very sudden dip and the very sudden recovery back up to where it is now, it's probably not a million miles off a sensible level. And the government has the tools to do more to prop it up if they need to, in terms of supporting the biggest businesses or even buying the shares of those businesses. Something that would have seemed outrageous at one point in the history, but now doesn't seem that way at all. The other factor is house prices. And if we assume that credit keeps flowing, which at the moment it is, and there's no suggestion that it's going to do otherwise, there's a lot that the government could do to prop up house prices if they want to. They could extend the various forms of help to buy. They could remove stamp duty. There's absolutely loads. So even though interest rates are at pretty much zero, I think there are still tools in their arsenal that they can use to fend off some of these threats, and I don't think they'll hesitate to use them at all. The thing that gives me pause, Rob, is this point around unemployment. Because for me, this is a real unknown at the moment. It's that question of, does everyone who's currently being supported by the government go back to work? Or does the furlough scheme come to an end and a large proportion of those people end up being unemployed? If you do end up with basically delayed unemployment and you've got millions of people out of work, does that threaten the boom scenario?
I think it does. And I think you've got right to the heart of it. I think this is probably the most important issue in the short term. And it will dictate which way we go. Because if you look at what's played out right now, I'm being general here, so there's going to be exceptions to what I'm describing. But unfortunately, right now, the people that have been hurt most in general by the crisis have been people in lower paid jobs. So you look at hospitality and travel. They're not industries that are known for paying well. They may be very rewarding, but they don't pay well. So the section of society that has been hit the hardest or has the potential to be hit hardest right now are the ones that are going to find it hardest to deal with. So the government has to get this right and support those people through this. And this is not just our government, this is governments around the world. If they, as part of their stimulus, carry on the furlough scheme, which would protect the majority of these people because it protects you up to $2,500 a month, or they have something else as a safety net to look after these people because these are the industries and the sectors that are going to take the longest to come back, then I think that protects the downside from playing out now. It allows the rest of the economy, things like finance, construction, manufacturing, to come back online, push things along enough until we get to a new normal where these industries can come back. Now, you could say, well, how long is it going to take for cruise liners to come back and how will the aviation industry recover? Yeah, they're going to take longer, but then it could drive money into different areas. Like we have a domestic holiday boom and a surge there as well to replace it. And that in itself will then create jobs. So it's not all lost one way and no gain anywhere else. It can be done. But regardless of that, it's this section of society that are feeling the most pain right now and need the most protection. And this is where the social unrest risk comes in, Rob, because I can understand why people in that position would already feel unfairly done by. And now that's multiplied. And at the moment, there's a lot of patience and there's a lot of goodwill in the country. Of course, there are exceptions, but on the whole, people are understanding of the situation. But that patience will only last so long. And if the government makes moves that hurt this demographic, then it's going to really cause issues. So I think you've absolutely nailed it. I think the unemployment issue, particularly for this section of society, is huge. And if they get it right and they protect these people, then I think that covers off a large proportion of the downside. And then all that stimulus I've talked about already pushes the upside, which then increases the chances of that scenario playing out.
I agree with all that. I think there's also a really important point around business confidence and consumer confidence, which of course are intertwined. I think that's important for avoiding what you could roughly call middle class unemployment. And I don't use that as a loaded term, I'm just trying to use it as a shortcut to say basically, if you've got a professional job, you earn pretty well, you then have a few months of being at home on full pay or close to it. You're saving a lot of money because you're not commuting to work and there's not a lot you can do. Summer holidays cancelled and you get the money back for that. And then you go back to work and you're feeling confident again. Then you're ready to spend because you've got all these things that you want to do and you're in a better financial position than you were before. The other version of that is you don't go back to work. That job just isn't there anymore. And if that happens, or if you perceive a risk of that happening because you're seeing it happen to others, then you're not going to be feeling so confident, and that spending is not going to happen, and jobs elsewhere. You're not going to go on that domestic holiday. You're not going to go on any holiday, and the jobs don't get created. For me, this is the unknown, and it's the most important thing that the government can do to try to steer things in the right direction.
I agree, Rob, and the government have to get this right. No pressure if you're listening, because if they don't, we're going into a depression now. But here's the reward for those who've listened in so far, because we don't actually believe that one of these scenarios will play out. We actually believe both will. That's our prediction. The prediction is that most likely, and this is not a guarantee, because the depression could come sooner, but we think that because of all the stimulus and the assumption that the government puts the right measures in place, Donald Trump's incentivized to make this work, which you can see happening, then we go into this boom cycle, and an aggressive boom cycle, very aggressive. It will make what's gone before look very small, and people are going to quickly forget about where we are now. You think impossible. I'm living this moment. That's because you have presidency bias. You are living today. You are biased to what you're experiencing right now. But in 2 years' time, if those credit card letters are coming through the post box every single day, buy-to-let mortgages are available at 85% or higher, anybody can get a loan, property prices are going up, people are feeling wealthier, you'll soon forget about today. And you'll soon start to believe the new normal, which is the world's in a great position and assets go up and we're all getting rich really quickly. We've been there before, right? If you're over 25, you probably can recall this. It was called 2004 to 2007. We've lived this before, and it will come again. But what happens is you can't sustain that. That train that I've talked about, that bullet train that's pushing the economy forward, that's going to drive asset prices up and up and up and up, hasn't got any brakes, and it crashes. I know, pretty grim, right? But that's what will happen. And when that happens, what have you got left? Because all your stimulus, all that money in, what are you going to do? You've done it before. That trick doesn't work anymore. It's played out. You've got a bigger crash now. No amount of stimulus is going to get you through this. Because what happens is people start to lose faith in the money system itself. What is this dollar or pound worth? It's fiat. It's created. It's not held against any other asset. There is no gold standard. So in the past, if you had a certain amount of currency, it was linked to a certain amount of gold. So it pegged to something. We don't have that anymore. If you just keep printing and creating money and inflating assets, at some point, particularly when there's a crash or a depression, we'll question the value of this money. And then this is when you have a reset. And Ray Dalio has talked about this in some detail, and we can cover this in a future podcast if there's enough interest. But when you have a reset, the way money is treated is very different. And this may sound very dramatic, but actually we've lived through this before, so don't think the world's going to go crazy and it's going to be some Mad Max future for us all. It's not. It's just some grim years. And all of it's done within a decade, normally. But what you may find is that we peg our money back to gold. We may even peg it to something like Bitcoin. Who knows? I'm not saying those things will happen, but what you do have is something different, because the faith in money has disappeared. People don't believe in it anymore. Now, I don't blame anyone if they're listening to this going, no. Because everybody, without exception, who's listening to this, hasn't lived through this before. But it has happened before. It was the last Great Depression. These things played out. So while we think, oh, this can't happen now, if I'd asked you 18 months ago, do you think the coronavirus is going to happen and the whole world's going to shut down? I'm sure every single person I'd ask would say no. So just because it's something radical doesn't mean it can't happen, right?
No, I'd actually say that it's a certainty that something like that is going to happen. It's just a question of when it happens. It's a question of how many of these normal, air quotes, boom-bust cycles you go through before things are at a point where you can't prop it up anymore and you have a complete reset and the world fundamentally changes. For a while, it looked like that was going to happen after 2008. We saw governments doing pretty unprecedented things in terms of interest rate cuts and money creation. That was effective up to a point, but growth over the last decade since then hasn't been particularly inspiring, and they haven't been able to get interest rates, for example, back up. So this time round, they have to do something even more extreme to keep things going. And how long can this go on for? Do they fail to prop it up this time round and you have a complete fundamental reorganisation of everything? Or do they get through this one and you're on to the next one? Do they get through that one and you're on to the one after that? It's impossible to say, but I do think it's inevitable at some point. What we seem to be converging on here is that that very extreme bust scenario is going to happen. It's just not going to happen right now. And we were talking off mic the other day, Rob, and you said something to the effect that you were short-term optimistic and long-term pessimistic. And I thought that's quite a nice way of summing up this idea.
Yeah, and that's how people should treat this. Because there's no point, if you believe what we say to be true, crying for the next 5 years waiting for a depression. Because you're going to go through an economic surge. Now, we talked about this for many times over the podcast. Whether you agree with this, whether you feel it's right or wrong, is not the point. Because you can't control it. But what you can do is you can take action. And you can take action around this to put yourself in the best position for the next 6 years. And then to put yourself in the best position for when things change. Whether the next crash is the Great Depression or not, there's one thing we are completely sure of, is that there's a next crash. So, like Rob said, it doesn't matter if we're wrong this time and it's just a normal crash. But if you prepare for a normal crash and it ends up being a bigger one, well, then you're going to be in a great position. And Rob, we've not talked about this for probably months, but the 18-year property cycle looks like it's potentially playing out.
Potentially, yes. If you believe that it's severe recession/depression now, then you can forget the property cycle. It's broken. But if you take the view that actually you get the boom next, then you could, if you zoom out far enough and forget the nature of why things have happened and you forget all the drama around it, take the view that the property cycle is indeed still operating exactly as normal. This is a very big discussion though, and one I don't know if anyone's got the energy for right now. So we're actually going to dedicate the whole of next week's episode to that very idea.
Yeah, and it's really important that you listen to that, because I appreciate right now you could be listening to this going, what? Like we've not gone mild here. We've been pretty bold with our views. But you can use the 18-year property cycle as a template for your action over the next however many years. And that's really important. There's no point in giving you big, bold predictions and saying, good luck, and then going off air. What we want to do is actually give you a framework that you can use to make the best financial decisions for you, your family, your loved ones moving forward. And that's what we're going to do next week. So it's really important that you do listen. The easiest thing for Rob and I to have done today is just giving you some middle-of-the-road prediction, soft falls, soft growth, and one of those things will play out. Because if we'd said that and we were wrong, people would have forgot it. Oh, they said a soft fall and ended up being a big fall, or they said a bit of growth and ended up being huge. So I know what we've said, and especially around that we think the boom cycle is more likely, is very bold. And it's probably the boldest prediction that we've ever made on the podcast. And we've made that boldest prediction in possibly the most troubled time we've been recording. Been recording over 7 years. And during that time, the economy's been through all sorts of things, including Brexit and lots of other drama. But right now is the darkest it's been for a lot of people in terms of their economic futures. And we've just painted the picture that we're about to go in the biggest boom cycle that we've seen for decades. So I know that comes across as very bold. But if you're a new listener to the podcast, please understand, this is the boldest we've ever been. And we've waited for it to be the darkest, to be the boldest. And that's not new thinking. These ideas, these thoughts, they're leveraged from people far smarter than ourselves, reading their work, watching their interviews, listening to their podcasts and going, okay, collecting all this information and bringing it together leads us to this viewpoint. But this viewpoint, if you believe it, means that you're going to need to be taking big action over the next few years. But this viewpoint, if you believe it, means that we're going into an incredible time for property investors over the coming 5-6 years. And next week, we're going to take you through step by step.
So a big episode this week, one that you'll want to think about, because more importantly than saying what we believe is most likely to happen, we've laid out the reasons for why we believe that. You might come to a conclusion because you weigh the different factors differently. But the important thing is that you do understand how all this works and come to your own view. This is something you're going to need to have a view on one way or the other, because what happens over the next few years will be significant. So this has been a big episode. We've got another big episode next week. So you will definitely want to join us for that one. And if you haven't had enough of us yet, we'll be back tomorrow with our market update podcast. And you can go check out our YouTube channel where that new video has just gone live. So until we see you next, take care. Bye-bye.
Bye-bye.